Hello everybody, in today's video we're going to discuss the potential of a stock market crash in 2021. Now, this isn't a topic that we're going to take lightly because a stock market crash would be terrible for all investors, but it's still something that we all need to be aware of. Recently, a lot of videos and news have focused on the potential of a stock market crash after the crazy year that was 2020. Now, to be clear, no matter what evidence we present in this video, we're not trying to predict a stock market crash or boom in 2021. It's quite frankly impossible to do so, and you should ignore anybody who claims to know. We're also not going to tell you what you should do with your investments, whether that's to pull all your money out or double down on that GameStop stock. Here at iQinvesting, we tend to subscribe to the idea that time in the market beats timing the market, and long-term investing is the best strategy for investors. But in today's video, we're going to go through all the evidence that points towards a stock market crash in 2021. Hello everybody, my name is Lewis and welcome back to iQinvesting, where we talk about saving, investing and everything in between. I just want to give a massive thank you to everybody who's supported the channel recently, whether that's through liking the video, subscribing or even just watching. Liking the video makes a massive difference, so if you're enjoying the content, be sure to smash that button. So again, we'd just like to say a massive thank you. With that done, let's get right into the content. Warren Buffett famously said that investors should be fearful when others are greedy, and greedy when others are fearful. What Buffett means by this is that when others are chasing greater and greater returns, be cautious. And when the market is frothy and volatile, be wary. Now, are the markets volatile and should we be wary? Well, yeah, just a little bit. We're going to lay out a few examples that show just how excited the market really is. The prime example of exuberance in the market at the minute has got to be crypto. Now, before you dislike the video, don't worry, we're not going to bash Bitcoin. We're not going to comment on the efficacy of Bitcoin as a store of value or a currency. We'll save that for another video. But why is the price so volatile at the moment? The crypto market is always pretty volatile. You don't need me to tell you that. But why has its price spiked again recently? Nothing has changed with Bitcoin since 2017. Yes, a few companies like PayPal have started to adopt the technology, but nothing has fundamentally changed with the asset. Some investors claim that the recent price spike is associated with a fear of inflation of fiat currency. But the thing is, the central bank started printing money in March of 2020. But it wasn't until October of 2020 that Bitcoin started its astronomical rise. If investors were really worried about hyperinflation and wanted to use Bitcoin as a safe haven, why didn't it happen sooner? Well, maybe the real reason that we're starting to see a crazy rise in the price is because investors are feeling FOMO. As investors see that the price is rocketing, they want to jump on the bandwagon. We can see extra risk taking all over the place. Penny stocks, popular with have-a-go investors, are in hot demand. Analysis by Themis Trading showed that the trading of stocks valued under $1 accounted for the fifth of all equity trading in the US on January 11th. The level of risk associated with these companies is quite high, but almost every day you'll see a new YouTube channel posting a video about a penny stock that is bound to 5x within a couple of weeks. We've seen this trend in other sectors too. Investors are willing to invest, taking on more and more risk without looking at the fundamentals of companies. The electric vehicle sector has seen a similar frenzy. Now, don't get me wrong, electrical vehicles are the future, and investing in sustainable companies is a great thing. But the prices and valuations of some of these EV stocks are quite literally insane. The Financial Times have put together a spreadsheet that includes most of the publicly traded EV stocks, battery manufacturers and charging companies. I've left a link to the sheet in the video description, so make sure to check it out for yourself. We can see the enterprise value, which is the effective value of a company. It is calculated by adding the company's market cap to their outstanding debts. From this, we can calculate the enterprise value to sales ratio, or EV to sales. This indicates the value of a company. This usually sits in the range from 1 to 3. Anything higher than this suggests that the market thinks that the future earnings will be higher, or that the company is overvalued. All the companies in this list have an EV to sales ratio of 28 or higher at the time of recording. Xpeng and Nikola have an EV to sales ratio of 70 and over 40,000 respectively. We put this down to FOMO. Every man and his dog has heard about the crazy gains that Tesla has made this year, and they want a piece of the pie. Again, let's remember what Buffett said. Be fearful when others are greedy, and greedy when others are fearful. Literally the week of writing this script, we've seen the internet potentially take down a Wall Street hedge fund. If that's not an indicator of how the market is a little crazy right now, then I don't know what is. Another one of the huge factors at play in the market at the minute is quantitative easing. Now this might sound a little technical, but trust me, it's actually really simple. What's not simple is trying to understand the effect it will have on the markets. For the sake of those that are new to investing, let's take a quick look at what QE is and what effects it could have on the markets in 2021. QE is a form of monetary policy where the central banks, like the Bank of England or the Federal Reserve in the US, buy fixed-term securities, like bonds, to increase the amount of money in the economy. When the pandemic first started in March of 2020, most of the central banks in the world started to buy government bonds in order to stimulate the world's economy. How does a central bank buying bonds change the amount of money in the economy? And what effect does it have on the stock market? Well, the central banks buy these bonds by creating new central bank reserves, the type of money that banks use to pay each other. Investment companies sell bonds to the central banks, and in exchange they get a large amount of money in a large bank, like Barclays. This means that Barclays would end up with a new money and a new asset, the central bank reserves. This has the effect of lowering interest rates because money is more readily available. The bank, in this case Barclays, will then be able to loan the money out and keep the economy going. Effectively, the central bank has increased the money supply into the economy, which lowers the cost of money. Lower interest rates means that we can borrow money more cheaply. This is great for governments at the moment because they are spending billions to keep the economy afloat, with schemes like furlough in the UK and the stimulus checks in the US. However, if too much money is introduced into the system, then inflation can occur. Inflation is the increase in the cost of goods and services. We can see this data published by the Financial Times, which shows that when money supply increases, inflation tends to follow. We've also seen a historic increase in monetary supply. Okay, again, you might ask, what's this got to do with the crash? Well, it's twofold really, and it depends on what the central banks decide to do. 1. If QE stops, then the supply of money also stops. This means that governments all around the world would be less likely to keep stimulating the economy, leading to unemployment and companies folding. This could lead to a market crash. Or 2, if QE doesn't stop, we could see rising levels of inflation due to the increased amount of money supply into the system. A sudden increase in inflation impacts corporate profits through higher input costs. This could cause a correction in the market as investors adjust to future expected revenues. Either way, it looks like we're in big trouble. But here's the thing, nobody really knows what's going to happen. What can we do as investors in these crazy times? Let's turn to Jack Bogle, the brilliant long-term investor and founder of Vanguard, to quote a speech that he gave in 1997 at the beginning of the dot-com bubble when stock valuations and investor behaviour was just as emphatic: invest you must. The biggest risk is the long-term risk of not putting your money to work. And finally, no matter what happens, stay the course. And with that, make sure to subscribe to the channel and follow us on Instagram at iQinvesting UK for more stock market and investing based content just like this every week. If you found the video useful, make sure to smash that like button and share it with a friend so that they can see this evidence for themselves. Do you have any thoughts about the possibility of a stock market crash in 2021? Let us know in the comments. As always, thanks for watching.